I added a company, like I chose Samsung for my own calculations. And as you write the name of the MNC on the Google or any of the website or the Chrome, you can easily find the information related to the question according to the financial information and disclosures. Here you can easily see the financial position, income statement, statement of change in equity, which I haven't taught you. It is related to the owner's own equity and cash flow statement. If I click on the income statement, you will see that we will get the financial report of the company. Here it is. In the formulas where we have to find out the gross profit margin, here it is. If you want to find it for the year 2022, here's the value. You're going to use this value and divide it by the revenue of that specific year, which is over here, and multiply by 100. In this way, you will get the formula answer. That's it. These are the things which you have to do in the questions as well. Clear? And one more thing. I don't know what company you guys gonna be choosing, but because I chose Samsung, they have created 3-month period income statement, balance statements as well. So it depends. It depends on the company's decision whether they want to make on quarterly basis or 3-tier basis or on biannually. This is the thing which I wanted to share.
So, ma'am, do we like just copy paste this report in the assignment, or what do we do?
Yeah, you have to copy paste the income statement, balance sheet, whatever the data you're choosing from. You can add that as well, or you can just put a reference link to it. It's up to you.
But it won't show the plagiarism, right? If we copy paste the whole sheet.
No, it won't, because that is the
Okay.
requirement now.
Hmm. Okay.
Otherwise, you can even add the link to it. I can check it from the link as well.
Okay, ma'am.
Um, in the next class, like after the lecture
Ma'am,
number,
this all data is from the website, right?
uh, what, Ikra?
This all data you're showing, the formulas and everything, this all is from the website, right?
Yeah. This is an income statement, which I showed you just right now. It was an income statement, which is also known as profit and loss account. It is open to the general public, so you can only find it of the big names. The small companies or the SMEs, they don't show their profit and equity statements on the websites, on the internet, or even to the local public.
Okay.
Uh, I think here it is. Okay. We are done with the learning outcome 2 as well till now. Now we are moving towards the last steps, which is 3.1, 3.2 assessment criteria. But I will start from 3.3 and we will do 3D1 today, the distinction task, because these two things are related to the task number 4. Here it is. From 3.2 and 3D1. So I've made the lecture according to it. And after this class, in the next class, which is the upcoming week, we will be doing the task. The learning outcome 3 states that be able to apply management accounting techniques. That is, now we are going to practically apply these techniques in the practical world. That is through the income statement and various questions. According to the assessment criteria 3.3, it says use capital investment appraisal techniques. Now, capital appraisal techniques or the investment techniques, these both things are same. So don't need to get confused. To evaluate a specific business decision. Now, how we can evaluate, define, predefine the specific business decision which we take in the organization according to the investment techniques. Now, what actually an investment appraisal is? The process of investment appraisal is used by the businesses to assess the viability of a proposed investment project. That is, whatever the project we have proposed in the company, in the organization, to our heads, to our project management lead, we have to tell that what the investment budget is going to be according to it. The key objective of the investment appraisal is to ensure that the project will generate sufficient return to justify the required investment. That is known as the net present value as well, which we have discussed earlier in various subjects as well as in this course as well. In the net present value, what we do, we find the value of the project, whether it's going to be a better project for us or not, will it give a more return or not. Then there are a number of different techniques that can be used. That is known as NPV, net present value, internal rate of return, payback period. Now, these techniques has its own strengths and weaknesses, so it is important to select the technique or the combination of the techniques that is most appropriate for the specific project. Now, we have to see of the viability of the project, which technique should be used. Now, these three techniques are already in the indicative content in your course outline or and underneath the roadmap. So I'm already sticking to it. The net present value takes into account the time value of money by discounting the future cash flows back to the present value. This makes the NPV particularly useful for the long-term projects with the complex cash flow profiles. That is, when we are having a project for up to 5 years, up to 10 years, or up to 3 years, then we can only use the net present value. Other than that, it is not appropriate to use it because it won't give the enough value back. If we talk about the internal rate of return, it is a measure of the return generated by an investment project, taking into account both the initial capital, that is the investment we have made in the project, and the timing of the cash flows. For example, in how many years we are going to get the return of that project, because we always multiply the return with the investment rate and with the interest rate as well. Payback period is a simpler measure which only looks at the initial capital outlay and ignores the time value of money. That is, it doesn't consider that at what time or at what year we are going to get the return. They only know that we are going to invest in it and how the project is going to be lead further. Is the outcome clear to you people?
Yes, ma'am.
These three things are going to be used in the calculations further as well. I'll be sharing the formulas with you, and I'll try to make sure that we will do a sample in a class. Do you have calculator with you?
Yes, ma'am, I do have.
And Hera, Lisa, and Rasha?
No, ma'am, I couldn't arrange.
No, ma'am, I couldn't arrange also.
Okay. Now there are different types of investment techniques. Again, it is the same thing. NPV, internal rate of return, and the payback period. Now, the advantages and disadvantages of using the investment appraisal techniques. There are a number of different investment appraisal techniques that business can use to help them make better decision about which projects to invest in. Each technique has its own advantages and disadvantages. Obviously, NPV has its own, IRR has its own, and so on. One of the most popular technique is the net present value, which is taking into the account the time value of money, which means that it can be used to compare projects with different initial costs. That is the upbringing cost or the new investment and different expected cash flows. NPV is generally considered to be more accurate measure of a project's true profitability than other methods such as payback period. So the number one method is always an NPV, which the businesses always prefer to use because we are sure that the calculation we are going to make in it, it's going to be correct. However, NPV can be difficult to calculate if we don't have an access to the good financial software. Obviously, in the organizations, we don't use the calculators, the scientific one. We do have the software of it, that is SPSS as well. But at the moment, I cannot teach you those softwares. It also assumes that cash flows will remain constant over the life of the project, which may not always be the case. Obviously, we have invested enough money in the project. We also need a cash flow out of it as well. Another common technique is the internal rate of return. It is similar to NPV in that it takes into account the time value of money. However, it doesn't require an estimate of future cash flows, which makes it simpler to calculate. This is often used as a quick way to compare different projects. When we are having project A, B, C, and D, we want to see the viability that how much year, in how many years this project is going to be going to give us the return. We use the IRR. It has some disadvantages. It can give misleading results of a project, such as uneven cash flow, because this is the advantage as well, because we don't take into account the cash flows in this. So it's a disadvantage as well. Or if the cash flows are reinvested at different rates. For example, in year one, we invested the cash flow at 10% discount rate, and in year two, we do 15%. So obviously, there is no parallelity in the cash flows. It also assumes that all cash flows occur at the end of the project, which may not be realistic. It can be assumed as well. It can be a round figured as well. Now, how to select the right investment appraisal technique for your business? The right investment appraisal technique can help a business to make more informed and effective decision about the investments. There are a number of different techniques which can be used, and most appropriate will depend on the specific business and investment situation. So whatever the XYZ situation is at the moment in the business, we are going to opt for it for the technique according to it. Approaches NPV again. It's take into account the time value of money and discount future cash flows to arrive at a present value. NPV is often used when the business are considering capital investment projects such as new machinery or buildings. Now, I think it should be clear till now that how NPV works. Whenever we are opting for a better project or new things, new assets, current assets or non-current assets, it depends on the organization decision. We are going to always opt for the NPV. And then for IRR, it is used for evaluating different possible investments in order to choose the most profitable option. Because IRR specifically is calculated, or this technique is used when we have various projects A, B, C, and D. And with the payback period, the most appropriate method will be depending on the individual circumstances. The business should seek professional advice to ensure they select the best technique for their needs. Now, this is the easiest one. In a project, in a meeting, whenever we are not clear that how to opt for the project, for the next project, we can always use this payback period. That if we are going to invest $50,000, in how many months or in a year, that is 2 or 3, we are going to get a return on it. That is the only reason the cash flow is not constant in it. Now it's a sample according to the AC 3.3, assessment criteria 3.3, which I added to your slides. A manufacturing company is deciding whether to invest in a new machinery for its production line. The cost and cash flows associated with this investment will be analyzed using 4 capital investment appraisal methods. Now, these things are added in your indicative content. That is the accounting rate of return, ARR, payback period, net present value, and internal rate of return as well. We will be using these 4 techniques or formula methods, or you can see appraisal methods, to see whether this scenario which I added to your slide, it's going to be profitable or not. The scenario is the manufacturing company is considering investing 500,000 pounds in new machinery for its production line. The expected annual cash flow generated by this is as follows. In year 1, it's going to be 100,000. And in year 2, it's going to be 150,000, then 200,000, 250,000, and so on. So I have taken 5-year values. The company's required rate of return, that is discount rate for this investment, is going to be 10%. Again, the investment is of 500,000 pounds, and then we are having different values for year 1, 2, 3, 4, 5. And the discount rate or the discount factor is always given in the questions, that is 10%. Now, if we want to calculate accounting rate of return, first we will see what it is. Now, it is calculated as the average annual accounting profit divided by the initial investment cost. Now, what was the initial investment cost in our case? It was 500,000, right? So the average annual accounting profit, how are we going to find that out? First, we need to calculate the average annual accounting profit, and that is by average annual accounting profit equals to total cash flows over the project's life divided by the number of years. And what was the project life? It was these year 1, 2, 3, 4, 5. So the probability in total is 5, and we are going to calculate all these numbers and add up 100, 150, 200, 250, 300,000. In this way, the answer comes to 200,000 pounds. Are you guys understanding it?
Average annual is the total one, right?
Yeah.
Okay, and initial, that is given in the question.
Yes. Here it is.
Okay.
The initial investment is given in the question, that is 500. And when we have to find the ARR, we are going to add up all the value for the year 1, 2, 3, 4, 5. And we will divide it by the number of years, that is 5. We are having 5-year values, right? So in this way, we are going to find out the ARR. After this, how we're going to add this in the formula, because ARR states for the average annual accounting profit. We have find that out. Now you're going to divide it by the initial investment, that is 500,000, and multiply by 100. I just forgot to add that. In this case, you're going to get the percentage. Whenever we have to find out the percentage, we have to multiply with the 100. Clear?
Yes.
Okay.
Yes, ma'am.
This is how we're going to calculate ARR. Even if in the task question it is asked that how to calculate the ARR of the specific year, we're going to do this like this, that like this, sorry. So the payback period. Period is the time it takes for the initial investment to be recovered from the cash flows. That is, whatever we have invested in the project, we have to get the initial investment we have invested in that project. So that is calculated by the cumulative cash flow. And that is by, let me just show you. In year one, our investment was £100,000, right? So it is going to be same. It can never be changed. But for year two, how we're going to calculate that? We're going to do it by 100,000 plus £150,000 equals to whatever the answer is. It's going to be what? It's going to be 250. And for year three, how are we going to calculate that? 250 plus 200. Are you getting it? I added it how we can do this as well. Like any of you in the
Yes, ma'am.
class, can please explain this to me so that I know that how to do. Is this clear to you or not? It's not
Yes,
difficult. Yeah,
somewhat is definitely getting in the head, but I think if we'll do it practically, then it'll be more,
yeah, but overall,
easy
are
for
you
us.
getting that how you're gonna calculate it?
Yes,
It's
ma'am.
just accumulating the result from the previous year and adding up in the next year. That's it.
For each years, we have to keep on adding the answers.
Yeah, you can easily see over here. Sorry, these were the value, the exact given values. But when we are gonna be finding the payback period, we're going to add up with the new values, with the answers which we get from adding the previous year answers. See, the value of 250 is added over here, and then the year 2 value was 200. We get 450. We will add in the year 4, 450 plus the current value. And for the year 4, it was 250. What do we get? We got £700,000. Are you getting it?
Yes, ma'am.
And
Yes, ma'am.
what was the main crux of the payback period? That to get the initial investment. And over here, you can see in the answers, we get the payback period in year 3, right? It is not 500, it is 450. We're not going to get the enough or the exact amount. We're only going to get the round figure. And if you remember, I did explain that in the previous slides that that is why payback is always discouraged, because we always get a round figure data. Because in year 4 and year 5, we are getting a profit. Clear?
Yes.
Okay. If you have any problem, do let me know now. You can even write in the chat box if you don't want to speak up. For the NPV, how are we going to calculate that? It's actually important. That is why, I added a paragraph to it. NPV is a financial metric used to evaluate the profitability of an investment or the project. It takes into account the time, value of money, which means that a dollar received in the future is worth less than a dollar received today. Are you getting the meaning of these lines?
Yes.
Can anybody explain it to me? Okay. So the investment I have made right now at the moment in 2023, in 2024, the dollar rate is not going to be the same, right? That is what an NPV is. That is why we always want more and more return in NPV. NPV calculates the present value of the future cash flows and subtracts the initial investment cost. A positive NPV indicates that the investment is expected to generate a net gain, while the negative NPV suggests a net loss. Again, like an income statement, we do face net profit and net loss. In the same way, in the net present value, we face the same things, because we don't know whether we are going to proceed a profit in this project or not. So that is why we always calculate NPV before proceeding with the project. Now here's the formula for the NPV. NPV equals to summation 1 plus discount rate. 1 is always, what do we call it? It is a notion. We cannot change it. And discount rate was in this question case 10%. T is the time value, and cash flow is whatever we generate the value of it, less the initial investment. Now, in your case, we are not going to learn the formula. We have to only put this in the calculator and then simply find out the values. It is very simple. Now, cash flow is the cash flow for the specific year. Discount rate is the rate used to discount the future cash flows back into the present value. T is the time year in which the cash flow occurs, and initial investment is the initial cost of the investment. Is this formula clear as well? I don't know where is the next one.
Yes, ma'am.
Okay. To calculate NPV, we need to discount each year's cash flow back to its present value using the formula and then sum up these present values. If the resulting NPV is positive, the investment is expected to generate a profit. I have added the same thing in various lines, like in various words, because this is very important. Students mostly lose marks in these parts. This is IRR. Now, this is a sample of the question that how we did NPV. We will discount each cash flow to its present value using the 10% discount rate and then sum up. So the NPV equals to summation cash flow. If you remember, for the year one, the cash flow was of £100,000, right? We're going to add that value. Then we're going to divide that with the discount rate plus one notion, that is 1 plus discount rate 10%. When we are going to calculate in the calculator, what we're going to do is we are going to multiply with 10% into 100. So in this way, we'll get a decimal. That is 0.10. And the time factor was 1 because it is the investment of year one. And in this way, we're going to do it for the rest of the years. That is 150,000 divided by 1 plus 10% discount factor and year two. Is this clear? It is very easy. You don't need to worry at all. I am sure when you're going to do it on your own, you can easily understand each and everything. But other than that, if you find any problem, you can tell me. For the year two, you can again see that the value is 150,000. That is your cash flow, and it is year two. So at the T, we are going to add 2. Are you getting it, guys?
Yes, ma'am.
And in the same way for the rest of the years as well, for the year 4, for the year 5 as well. And in the end, we're going to subtract it with the initial investment that was £500,000. And we will get the rounded figure that is 131,728.39 pounds. This is your net present value. This is how we calculate the NPV. And in your case, in this question, we have faced a positive NPV. This means we can proceed the project further. If we come with the IRR, that is the internal rate of return, it is the discount rate at which the NPV of the cash flows becomes 0. It is natural or a subtle thing in this technique, IRR. The NPV always becomes 0. We have to take that N0. It is the rate of return that investment is expected to generate. In other words, it is the rate at which the present value of the cash inflows equals to the present value of the cash outflows. That is your inflows, whatever you invested, £500,000, is going to be equal to your outflows as well. The formula for the IRR is not straightforward to solve algebraically, so it is typically found using financial software or calculators. That is, we can use scientific calculators plus the softwares. In the organization, we use only softwares. So you can think of the IRR as the rate that makes the following equation true. So it is this discount rate at which the NPV of the cash flows becomes 0. It is the rate of return that investment is expected to generate. In other words, it is the rate at which the present value of the cash inflows equals the present value of cash outflows. It is again the same thing. So again, this is the breakdown of the same thing, which we can read it later on, or I'll just read it right now. From point number 3. Internal rate of return is ideal for analyzing capital budgeting projects to understand and compare the potential rates of annual return over time. In addition to being used by the companies to determine which capital projects to use, that is, we are having various projects at the moment in an organization A, B, C, and D. So it can help investors determine the investment return of various assets. Obviously, we are getting the investment from the investors, from the shareholders. So it is their duty to check whether which project is going to give the return on an earlier period. Keep in mind that internal rate of return is not the actual dollar value of the project. It is the annual return that makes the NPV equal to 0, because we don't know, we are investing it at the moment at a rate of $300 or 50 rupees per dollar. But what happened is at the time of 2024, 2025, the dollar appreciates or depreciates. We don't know. We don't know the economy, whether it's going to, because at the moment we're facing recession. All over the world, we're facing hyperinflation and inflation at the moment. So the investment in the project is very risky. That is why in the developing economies, people are at a very high rate of risk. They're going to default very soon. That's it. This is the formula for the IRR. The formula for the IRR is not straightforward again. Net present value, we have found that in the project that was around 1.3 something. And this is how we are going to solve it. And I have break down the formula in the further slide. Zero is always going to be same as I told you earlier. The formula says submission 1 plus IRR rate into the time t multiplied by cash flow less the initial investment. Now, if we break down this formula over here, generally the formula is look like this, but in your case, we have breakdown like this. So it's easy to calculate. The cash flow is the cash flow for the specific year. The IRR is the internal rate of return. T is the year in which the cash flow occurs. And initial investment, it is the initial cost of the investment. Now, according to the sample question which I added in your slide, this is how we are going to make up with the question. The formula, after putting all the values, we get the IRR approximately 17.41%. And in this case, we have used again the rate of return to 10%. And one more thing, it is more feasible that we use a scientific calculator. Other than that, we can use a software as well. But at your stage level 4, we don't advise that at all. Any questions so far?
No, ma'am, no questions.
Okay. And this is the concluding paragraph. Investment appraisal techniques can provide invaluable insight into making the best decisions for the businesses. Now, evaluating potential returns and considering the long-term strategies, business can make informed decisions that are in line with their goals. Obviously, when we make these projects calculation beforehand, we do get to know that whether we should proceed with that further project or not. And in this way, we are viable for the risk. But most of the multinational, what they do is they do take the risk. If the project is not fruitful, they do invest in it. Why? Because we don't know that what is going to happen next. With careful research and analysis of the available investment option, business can benefit from a well-rounded review process to ensure each decision is made confidently and effectively. Now, again, the thing which I always repeat in every class, please do add a concluding paragraph to your answers. It is very inappropriate, even if I end up my question or my lecture like this, that making it an attractive investment with 10% return. We have to end up a question like an answer like this. Okay. I have to do the distinction task as well today. It says evaluate the command where we're going to discuss the strengths and weaknesses and so on with it. Now, evaluate the benefits of management accounting techniques that support the financial decision making to ensure long-term financial stability. So we are going to discuss the financial accounting as well and the management accounting as well, and that how they affect the long-term financial stability of a business decision. Management accounting is a field of accounting that provides financial information and analysis to the managers and decision makers within the organization. So whenever we are going to talk about the management accounting, it is directly related to the organization, managers, and the decision makers, that is the CEO and the head of the directors. Its purpose is to assist in planning, controlling, and decision-making process through the use of cost-benefit analysis, budgeting, and performance measurement. And how we do the management accounting? Through these things, that is the cost-benefit analysis, budgeting, and performance analysis of the employees. While the field is often used interchangeably with the financial accounting, it differs in that it focuses on the internal financial reporting rather than external financial reporting to the stakeholders. When we are going to report through the financial statements, to the stakeholders, we're going to talk about the financial accounting. And when it is internally, like internal related to the management, to the employees, to the board of directors, we are going to talk about the management accounting. So it is the key difference, which basically you can add in your assignments as well. Now, the techniques and tools which are used in the management accounting. Some of the commonly used techniques in management accounting include the variance analysis, marginal costing, and activity-based costing. These tools provide managers with valuable insights into the cost structure of their organization, enabling them to make informed decisions about the pricing, production, and investment. So these typically accounting techniques are related to calculate that what the price is going to be, what the production look like, and how the techniques are going to be used further. And however, the implementation of these techniques can be time consuming and costly and may require significant changes to the existing systems and processes. Variance analysis, the first thing. It is a technique which is used to compare actual financial results to the budgeted or the expected results. For example, I wanted to I invested 100,000 pounds in a business in any project. Now, what's the variance analysis to it? I wanted to expect to go it to 300 or to 400. Whether we meet that requirement or not, that is going to be a variance. That is a difference. Now, by analyzing the difference between the two, managers can identify areas of the organization they may be performing above or below expectations and take appropriate action. Now, again, how we can use variance analysis in the department as well by calculating the investment we are making into that department. For example, if it's a manufacturing department or a R&D department, it's obvious that the research and development department needs more investment. Are we getting more fruits to it or not? That is how we can easily get to know through the variance analysis. Marginal costing. On the other hand, it involves separating the fixed and variable cost. Fixed costs are the one which cannot be changed no matter what. We have to pay the rent and it's viable for us. And variable costs are the one which changes over time. For example, if the dollar rate over at the moment is 350 rupees per 1 rupees, then in upcoming time, what it will be? Again, it is going to be appreciating, it's going to be increasing. This information can be used to make informed decisions about the pricing and production volume. So marginal costing is related to the pricing of the products and the production department. Finally, activity-based costing, it is a technique that assigns cost to specific activities or processes within organization, and managers can identify the areas of the organization that are more or less efficient and make changes accordingly. That is, they're going to do more investment, they're going to do, maybe they're going to give more just in time, or maybe more workshops to them, more training. In this way, they can cope up with them and motivate them to produce more efficiently in the organization. The number first factor is the budgeting, because the command word was evaluate, so I added the strengths and weaknesses as well. The strengths of the budgeting are planning and controlling, resource allocation, and performance evaluation. If I just discuss this generally, planning and controlling, why? Because obviously when we are budgeting, we have to budget everything. We have to add an expected price, what will be the outcome of this thing, what we will do if this project never goes up or it just destroys the other projects. So we have to plan and control each and everything through assigning the duties to various departments and to the team members. Resource allocation. We are not having enough resource at the moment in the organizations. That is why we're doing the planning and controlling and budgeting. So we have to see that what amount of raw material, whether it is a processment or input, we have to apply in the products. Then performance evaluation. How it is, we can say, added to budgeting. Why budgeting has performance evaluation? Because it depends on the employees, the workers, the team workers, that how they perform in the organization. If they are more efficient, we can give the extra commission, or you can say as a salary to them because they worked hard. And we are going to add that in the budget as well. Like this much amount we can give as an extra fringe benefit to XYZ employee. Clear?
Yes, ma'am, clear.
Okay. If
Yes,
we talk about the weaknesses of the budgeting, it is having a rigidity, time-consuming, non-financial factors, and organizational preference as well. If we talk about the rigidity, these are the fixed budgets which may not adapt well to rapidly changing environments. For example, we don't know that if we want to proceed the project in a colder area or in a hotter area. It depends. Obviously, we're facing the global warming at the moment, so it can affect the budget, your budgeting cost. Time consuming. Preparing and managing the budgets can be time intensive, diverting the resources from other critical tasks. Maybe we're not having a good relationship with your supplier. We're not paying him on time. He is having a lot of credit purchases. So what will happen? He's not going to deliver the product on time, the raw material to us. Non-financial factors budgets can be aligned with long-term strategic goals by including non-financial performance metrics and objectives. That is why we have always it is recommended that or whatever the strategic management goals we are going to opt, it should be according to the organizational goals as well. And in the end, some organizations may prefer traditional budgeting methods, while others may adopt more flexible approaches like rolling budgets depending on the organizational culture. So, budget is not about calculating and making the income statement and profit and loss account or in financial statements. Budgeting has a variances. We have different software as well through which we do budgetings. Even in the household, we do budgets. Then we have variance analysis. Again, they are the strengths and weaknesses. In the strengths, we have performance monitoring, cost control, decision support. Why variance analysis has decision support? Obviously, we're going to take a difference from two things. So we have to have a support from the different decision makers as well. Then cost control, we are going to get the control of the cost as well. Why? How? Because we have to see the area which are causing problem in the longer time. Then performance monitoring allows organization to track actual performance against the budgets and identify deviations in the real time. Like if we find any difficulty or differences, we are going to jot it down, we're going to correct it. Weaknesses, complexity. Interpreting the variance can be complex, especially for the non-financial managers, like the one which don't have any background to the finance, they're going to have a problem. Then overemphasize on the cost. Focusing solely on the cost variances may neglect other vital aspects of the business performance. Other than cost, other than budget, we are having other problems or other tools as well, like how the employees are performing, whether we are taking care of them, what are the environmental factors, is there any competition which we are going to face in the future? We have to see the other factors as well. Then organizational preference variance analysis is a common practice in most organizations due to its effectiveness in the controlling cost. So it is the most top one. Then we have activity-based costing, ABC. The strengths are accurate cost allocation. It provides precise cost allocation by considering the activities that drive cost because we're calculating specifically the cost which is going to be viable on that specific project. Then better pricing decision helps set optimal prices by understanding the true cost of products. Like you have seen that whenever we go and purchase a product nowadays, we always get it to the market price, markup price, and GST is added to it. So it is already calculated by the organization. They saved up their own commission, their actual price, and the profit they want to gain from the consumers. Cost reduction identifies activities that do not value and can lead to cost reduction opportunities. Obviously, as a financial accountant or a financial manager, it is a reliable duty that we have to reduce the cost, no matter what. It depends, are we going to apply a good quality product to the consumers or not? We have to regain our cost. Weaknesses, complexity. Implementing and maintaining the activity-based costing system can be resource intensive and complex. Obviously, we have to look at each and everything, so it is complex, it is difficult. Maintenance requires ongoing maintenance and adapts to remain relevant. Maintenance on the employees and the production line, both. Non-financial factors, now they support long-term financial stability by aligning the cost allocation with the strategic priorities. That is whatever the decision you're going to take in the organization, plus in the projects. Then the ABC is often preferred in the industries where the precise cost allocation is critical, such as manufacturing department. It is always recommended to use the activity-based costing over there. Then we have balanced scorecard. These techniques are already in your indicative content, so we have to discuss all of these. The holistic view incorporates both the financial and non-financial metrics aligning with the long-term organizational goals. Strategy execution helps organizations implement and monitor strategic initiatives by translating them into measurable objectives. Now, how we relate the balanced scorecard, that is your company financial health well-being, with the strategy execution, that is how we are going to execute or penetrate an ABC project into various departments. Feedback mechanism provides a feedback loop for adjusting strategies in response to changing conditions. Again, feedback is very necessary, and specifically when we're using the balanced scorecard, like it is related, it is more like kind of survey of the organization of a whole loop. Weaknesses, again, we have complexity to it, subjectivity, and non-financial factors as well. And if we talk about the preference, it is related to the strategic focus, often preferred the balanced scorecard for its comprehensive approach, because everything is combined, is scrutinized in just one page. Are the organizers or the organization people are happy or not, we can easily get to know from the balanced scorecard. Some recommendations for improving the management accounting practices, which include investing in the information technology system to streamline data collection and analysis. Obviously, when your IT department is advanced, it is up to date, we're going to use more software rather than doing the manual calculations. Providing the employees with the training and support to help them understand the new tools and processes. Again, if we want to deliberately succeed in the market, in the industry, we have to invest the money on the employees as well. How? By training them, by giving them various workshops and upgrading them and promoting them. Communicating the benefits of management accounting to the managers and employers to get their buy-in. Again, like I don't feel like it's even a recommendation because everybody knows that it is necessary. But communication is very important. Like we have to talk. Talk as a teacher, as a student, it is necessary. Like we build a bond. And when we build a bond, it's definitely fruitful. Continuously evaluating and adjusting the management accounting. Obviously, we cannot stick to one goal or one what do we can say recommendation. We have to change it over time. Management accounting techniques offer a range of tools to support financial decision making for the long term financial stability. Each method has its strengths and weaknesses, and the choice of the technique should align with the organizational goals, vision, and preferences. Integrating non financial factors and considering the specific requirements of the long term financial decision is essential for making sound financial choices that contribute to an organization's stability and growth. This is the concluding paragraph of the whole 3D1. Any questions?
No, ma'am.
Ma'am,
Okay, that's great. I hope you guys have understood everything. That's it for today's class. Thank you so much. You may leave.
thank you. Allah Hafiz.
Allah Hafiz.
Allah Hafiz, ma'am.
Allah Hafiz, ma'am.